Hey, John here. In this presentation, I want to step you through what's something that's actually happening in that, and it's quite exciting, not that I'm going to do this, is that website portfolios are bringing on investors to raise capital to expand and scale their website portfolios. There's a number of ways we can do it. I'm going to step you through, and for each scenario, I'm going to present a series of charts, good, bad, and moderate outcomes. So the three scenarios that I'm going to compare here would be: one is sell-preferred shares, which is essentially borrowing money. It's paying back investors a stipulated % every year and then paying the principal back at the end of, I use the example year 5, but you could structure this in many, many different ways. The second scenario is selling equity, which is basically giving up a certain percentage of your portfolio. The example I'm going to use is selling 75% of your existing portfolio, keeping 25%. And the third scenario is comparing it to what would happen if you just kept your websites private and not bring in investors at all. So I've got a whole slew of messy charts. These are broad strokes analysis here. I'm not a financial analyst. There's obviously going to be things not accounted for. I just want to get a big picture idea of what's possible and try to keep it apples to apples as much as possible. So our preferred share situation is raising 10 million. So each year we need to pay, we're saying a 12% return, pay 12%, 1.2 million back to investors on that 10 million raised. And then at the end of year 5, pay back the 10 million plus another 12%. So you can see the pay to investors row is here. And this scenario is the good outcome scenario. So we have a positive growth, 15%, 17%, 25%, 17% each year. These are pretty good numbers. Note that, websites can grow. If they're well managed, they can grow much higher than this. So this is not really beyond the realm of possibility. And then we have a bunch of other numbers in terms of the accruing value of the portfolio and then cash on hand. Now, as you'll see in the other chart, the other scenarios, I reinvest each year right up through year 5. The reason I don't do that here is because we need to build up the cash reserves ultimately to pay back the investors at the year 5. What you don't want to end up with is a huge portfolio, lots of websites, but you don't have sufficient cash to pay back the principal. You have to account for that in this scenario. We don't in the selling equity or keeping it private scenario. So that is a big difference. So as you'll see here, the outcome with this sort of growth, raising $10 million, is very, very good, with a potential value of $18 million. That's huge, considering the value of portfolio in year 0 was $1.8 million. That's leveraging big time. Now, I'm going to preface this entire presentation and analysis on this. We are reinvesting most of the income earned. Okay, so this is not accounting for paying out fairly large salaries, say the portfolio owner and all of that. Okay, this is this is definitely skewed in the higher end of it because it's not taking into account that. And the reason I didn't do that is because it would be difficult to, I guess we could have come up with a net salary that would be paid to key players. We wouldn't know how many key players there would be. So you would definitely need to account for having to pay some pretty big salaries along the way, which would reduce the total amount reinvested. So I just want to preface that, but I kept it all the same across all the charts. Okay, preferred shares, which is basically borrowing, bad scenario. You can see here we end up in the hole. Negative 8 million is the cash on hand that's owing. That's because you got to pay back the investors. Whole thing went disastrous, and it's a disaster. So when you leverage big time, when you borrow money, it can go really, really good or really, really bad. And then we got a moderate scenario, which is a straight 5% growth rate across each year. And as you can see, that turned out quite nicely with a little over 8 million valuation. Notice here, though, that this preferred share situation, while it can be very, very good, it's also very, very risky. And as you'll see when I'll do a full comparison chart of everything, an overview chart. It is the most volatile. The next scenario is the selling equity. And the example we're doing is we're selling 75% of a portfolio valued at 1.8 million. I'm actually kind of using my couple of niche sites, not fat stacks, not included, as an example of this. That's why I stepped it through this way. And so this would be an outcome. Now, this is a lot more complicated. I actually made a mistake the first time I published it, and the FatStax readers, when I sent this out in the email, got back to me and corrected me, and it was a good observation. Anyways, the situation, you're going to end up with with the good outcome. We've got two charts we really need to create, because what we do is we sell 75% of a 1.8 million valuation. What that results in is we get a influx of cash of $1.35 million. But that doesn't go into the with the other investors. The investors is what I call sort of the fund, and then the private proceeds. That 1.3 million is clear to the portfolio owner. That's why you sell it. You get all this cash. So then essentially what you can do is you'd be tracking two different website portfolios through that. So you'd be taking the 1.3 million. This would be the fund that the portfolio owner would own entirely, would reinvest it. Let's assume would buy a website or websites that would come to that amount, and then enjoy the growth and net income from that entirely. So this would be owned 100% by the original website portfolio owner. And this is the fund that was sold. And so the portfolio owner gets 25% stake in this, 75% to the investor. So you can see how that would all grow out. In a good situation, the result is quite good. It's not as good, not even close as good as when you borrow the money, but it is good nevertheless. And there's a lot less risk, as you'll see when we get to the bad outcome, which is here. So our bad outcome is we end up with a valuation of just under $4 million, which is pretty good considering the value at the front end was 1.8. So even in a bad outcome with some negatives is not disastrous. You're not in the red, you're not wiped out, you're still in business, so that's pretty good. Keep in mind again though, just like I kept our upside growth somewhat on the conservative side of things. I mean, this is good growth, but it's not the best growth you could experience. Same with the downside. I kept it fairly conservative. Minus 40% drop in 1 year is pretty bad. This would principally be a result of some bad Google algorithm updates, generally speaking, or something bad would happen with some affiliate arrangement or something like that. But you could have worse outcomes than this. This is not a worst case scenario. This is a pretty bad scenario for 4 years suffering losses like this, but it could be even worse. So I just want to keep that in mind. I mean, for instance, you could have in year 2, negative 60% drop, which is going to significantly impact the outcome here because you've lost so much value up front in the whole process. So this is just one of many potential bad scenarios. The outcome here, though, is not a horrible, disastrous business ending outcome, but it's not great either. And if we go moderate, which is again the 5% growth straight across the board, we end up with a little bit over $9 million investment. So as you can see, the leverage again from selling equity can be very, very good. But we're going to compare this now to the last scenario, and that is staying private. And again, please remember, we're reinvesting almost all the money that's earned. We're not taking account into salaries being paid out. So this is inflated for certain. Okay, now stay private, good scenario, same growth rate. We're going to end up with a valuation of $12 million. And that's really good. Now, that is not to say that in 5 years, if these are my numbers, I'm going to end up with that much money. It would be wonderful if I did, but the fact is I do take out a salary, and so that is going to reduce the amount that can be reinvested. You can see here when I got cash on hand of $600,000, reinvesting $500 back in, and then you got $900. I'm reinvesting in this scenario most of the money. A bad outcome is not horrendous. It's still up, and it's up because we're reinvesting. If you would pull out all the money each year, you'd be way down. Okay, so this is going to be one of the comments I'll make at the end, is how important it is to actually continually reinvest in your business if you have a good business going on currently, if it's actually profitable and it's working well and it's got good growth. Now, the moderate outcome is also quite good, a little bit under $9 million. So that is the 3 scenarios. And let's jump into an overview here so you can sort of compare them all. We've got our 3 scenarios on the left, and we've got our good, bad, and moderate outcomes here. And as you can see, the best possible outcome is preferred shares with over $18 million. You can see selling equity and staying private is somewhat similar, which is pretty interesting. So, which is not entirely surprising, because I mean, when you're selling equity, you're giving up 75% of a current portfolio, assuming that growth is going to be the same as another website that you invest in. So it's almost like, I don't know why you'd maybe do it, except maybe you want to diversify your holdings, but that would be about it. And same with the bad outcome and the moderate. They're not much different between selling and staying. But when you look at our preferred shares, bad is bad. Moderate is kind of in line. So If you're really swinging for the fence and you're a risk taker, the preferred shares is the way to go. Otherwise, either sell the equity and reinvest it, or the proceeds, or just stay private. So let's dive into the comments here. The first, I've already mentioned this, most of the proceeds being reinvested. It's an inflated analysis. Okay, most people would take money to live on and so forth. Borrowing, I've already mentioned this, is the riskiest opportunity with the biggest upside for the portfolio. I didn't actually expect this. I didn't really know what to expect. I've never even entertained such a bunch of scenarios or doing any of this, but I've just been reading that it's been happening. This is actually something that's going on with portfolio investors, and I thought it would be interesting to do. Clearly, there is something to it because people are doing it, and they're not going to do this sort of thing for nothing because it's a lot of work to set up. Selling equity is not an option unless you have an existing website or websites already spitting out consistent cash. All right, let's keep that in mind. So it's only going to be people with fairly big websites are going to be able to do that. In terms of raising funds via preferred shares, generally speaking, you have a much easier time of it if you already have websites that are spitting out cash. But if you don't, but you can convince investors to invest anyway and give you piles and piles of money and then go out and buy the portfolio, well, good for you. That's even riskier, but that's a possibility. That is not beyond the realm of possibility. Huge assumption is the ability to find and buy good website assets with the funds, okay, especially with the preferred share where you're borrowing that basically is $10 million up front. And when you got to assume you're going to be able to buy $10 million worth of web properties fairly quickly, you're assuming in year one, that's going to actually generate a pretty good return. All right, so that's not necessarily an easy thing to do, to find good assets to buy. I'm sure it can be done. I mean, you can buy a couple of really, really big sites and it's spent, right? I think that would be the approach most would take. I don't think you're going to buy 50 small websites. I think in this situation, you'd be looking at aged, consistent, established brands that are spitting out consistent money. You have to remember, if you offer an investment opportunity, you give up a lot of control, and you also may be subject to regulatory bodies. Okay, this is a big reason I really wouldn't entertain this unless the money was ridiculous. But as I can see, I'm not really into taking on the risk of leveraging the money at this point, and I just really don't want to give up control. I like being able to do what I do. If I end up with a smaller business, so be it. I really do enjoy having that full control. And as I've already mentioned, reinvesting is critical. You have to reinvest. If the whole scenario had been set up without reinvesting much money over the years and just pulling out every nickel that came out, the outcomes would be dramatically different. Okay, I admit this entire analysis is inflated because we're reinvesting so much money, but if you took it all out, the results would be much, much, much lower. And most important, it really comes down to being able to manage the web properties well. I mean, there are factors beyond our control, Google algo updates and so forth. But if you can manage the web properties well and hire good project managers to run them, and you can get a consistent return, you can get a consistent 15-20% return, as you've seen, and you reinvest a good chunk of that, the outcome and leveraging of taking on investor money can result in big results. But it's got to be managed well, and this is why it's not really something you want to consider until you've had fairly long-term success being able to manage your own websites and have systems in place to scale up. Because, it's one thing to have one website. I'm not really focusing on many websites these days, but when you're trying to grow multiple big websites, that is a lot to go on, and you're going to need to hire some really good people and to have systems in place for it to actually work well. Lastly, you can grab a free course that I set up called 6-Figure Baseline Blogger at fatsexblog.com.